Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at Capis. Welcome to our monthly research call. Capis would like to thank all of you for taking the time out of your busy trading day to spend time with us. We hope that you find the information in today's call insightful and that it sparks debate about the capital markets and trading strategies. In order for us to serve you better, there will be a brief survey at the conclusion of this call that we'd appreciate everyone taking just a few minutes to fill out. Thank you very much for doing that. Before we get started, I have to get the legalese out of the way. So let me start. The opinions expressed by the featured speakers are neither those of Capital Institutional Services nor its employees. This presentation is not, and nothing in it should be construed as, an offer, invitation, or recommendation to sell, or a solicitation of an offer to buy any securities that might be mentioned. And now on with the call. First up to speak with a few introductory remarks is David Choate, our COO and Executive Director of Sales and Trading here at Capis.
Thanks, John. I'm Dave Choate, COO of Capis. In the past, I have made a few comments in these opening remarks to give you guys an update from our trading desk, to share some data from the Capis universe. But today I'm interested in what Brendan and John have to say. So I want to reiterate John D'Antona's comments. Thank you all for joining us. And I thank our friends at Market Policy Partners for sharing their analysis. With that, let's get right on to the call. John, back to you.
Absolutely, Dave. Thank you. And now I'd like to turn it over to our special guest today, the gentleman from Markets Policy Partners. But before I do, please note that John and Brendan will take questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom, and I will be sure to get to them. Now, I'd like to begin by introducing John Fagan. From 2014 until September 2018, John was director of the U.S. Treasury's Markets Room, and prior to that, was a senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indexes, foreign exchange, and rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law School. Also, I'd like to introduce Brendan Walsh. From 2006 to the summer of 2018, Brendan was a senior analyst at Discovery Capital Management, covering global financial institutions, and was part also of the global macro team focusing on macro data, rates, foreign exchange, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development, and was an International Travel Fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, welcome to the call.
Thanks very much for having us. We're really pleased to be here. And thank you for the kind introduction. We're Markets Policy Partners. I'm John, that's Brendan, and you can find us on the web at marketspolicy.com. We're a DC-based advisory service, and we inform our clients on matters at the intersection of finance and policy, and have a wide array of clients across the financial sector, but also in the public sector as well, and corporates. DC is has been a busy place to be, and we certainly have a lot going on. So without further ado, let's jump into some of the themes here. I'm going to share my screen with, hold on just a second here. The slide portion will be, hold on just a second here. Apologies. So let's see. So we've got a variety of topics to cover today. We're going to start with basically rundown. We're going to start at the bottom actually with the Fed policy expectations that are playing a role in driving financial market cross currents these days, and then go into a discussion of economic uncertainty and inflation expectations. This is going to roll into a discussion about the American Jobs Plan, our outlook for infrastructure investment. And then we're going to have some brief remarks on cryptocurrency regulation and U.S.-China. We're going to leave plenty of time for Q&A. We want to direct this call in however is most useful for the participants, and thank everybody for joining. So first off, The Federal Reserve, we've had a barrage of Federal Reserve communications. We're going to start out with our base case for where we see the Fed going. We believe that the dovish majority will hold off the hawks here, the vociferous, increasingly vociferous hawks led by a lot of particularly the regional Fed presidents, among them Dallas Fed President Kaplan, St. Louis Fed President Bullard have been among the most straightforward and hawkish in their intonations over the last couple of weeks. But we think that Chair Powell, as he's demonstrating in his testimony before Congress today, is going to hold his consistent line and commitment to current levels of accommodation, despite the fact that taper talk is obviously begun and will continue. We expect taper talk to remain just talk through the fall, and we expect that around the fall they'll be coming out with the outline of a taper plan, a program, but they will fall short of announcing an actual taper until we think the early part of 2022, first quarter, is when we expect them to begin the process of tapering, which is, it is not too far out of consensus, but I think the recent communications from the Fed have maybe pulled forward some of those expectations. We think that's more about, the sort of the bullhorn, so to speak, that the hawks are using these days, rather than where the real center of the committee is. What's the basis of our understanding here? Part of it really is that, the Federal Reserve is looking at a September-October threshold for some really key aspects. Yeah. And that's something we've talked to our clients a lot about. And one of those is, it's not just the variant. If you're going to see a comeback with the Delta variant or one of the other named variants, very likely it's going to mirror the kind of seasonal uplift that we got in cases last year, which started to take off around September, October. And that is intertwined with the back to school dynamics, which Brendan can speak more about.
Yeah, and that's really it's just kind of almost common sense. We shut down schools in a huge amount of the country, and it screwed up our back to workforce. There's, I think 7 million women who dropped out of the workforce. So it just doesn't really make sense to make a huge policy change until you see at least September and probably also October jobs data to see how, if we are going back to normal and people are going to come back to the workforce, or whether things are totally different. And maybe we need, we do think the September and October data will be good, which will then allow the Fed to begin the taper discussions. But it just doesn't make a lot of sense for them to do it. And also, Powell's also is interviewing to keep his job. So, I would say he has a much higher chance of keeping his job by staying dovish rather than getting hawkish unexpectedly.
Yeah, and one of the things that Powell has been talking a lot about in his most recent speeches is referencing this shift in the mandate on full employment. Full employment is expressly now focused on lower socioeconomic echelons, the service and lower income service sectors, more impacted minority groups. Chair Powell is beginning to talk more and more about this. And when you look at the BLS, the labor market surveys, those are clearly lagging behind the recovery. And that's something that we expect the doves on the committee to increasingly rely upon in justifying continued quantitative easing, current levels of accommodation. When it comes to the housing market, obviously that's one of the things that the hawks are pointing to. Hey, we've got to start peeling back the MBS purchases because it's setting the housing market on fire. A lot of the discussion in Washington, D.C. is really about this. It dovetails with some of the discussion, we'll get into this later, about inflation, which is sort of a burst of demand that is mismatched with supply that isn't necessarily durable in character, and not really owing to the Fed's to the low interest rate environment or anything the Fed is doing, so much as kind of the anomalous pandemic impacts that are having on home buyers and the property market. And so it's that, I think, is also something that the doves are going to try to push back on. And we've begun to see, a New York Fed President Williams begin to talk about that as well. So we think that the committee is the center of the committee is dovish, and will probably continue to and will continue to hold that line. And one last thing on it, our expectation has been that that Fed Chair Powell will not be reappointed, although it's a pretty close call. We think it's going to be Lael Brainerd is going to be put in as Fed governor. Though the word around Washington, she was going to be Treasury Secretary if Hillary Clinton had won. She was supposed to be Treasury Secretary. She was certainly on the short list after the Biden win. But she was left on the Fed board, and the scuttlebutt around Washington D.C. is that she was told, just wait on the Fed board, something good is coming your way, and she is obviously an arch dove on the committee, and has been extremely to the forefront of those revised mandates that we've been talking about. So moving swiftly on from the Fed, clearly the markets have reacted to the more incrementally hawkish shift in June, and we don't think that that's too far out of line. They've obviously begun a process, but we think it takes us into early next year before they start to taper. On the growth front, we've seen this dynamic. We'll talk a little bit about inflation in a minute, but we've seen this shifting paradigm from overheating fears to questions about the fortitude of the recovery. And this is a combination of aspects behind it, not the least of which, of course, is the rise of the Delta and other variants, questions about whether that's going to impede or roll back some of the benefits and some of the progress on reopening. And that's clearly being reflected in the yield curve and some of the economically sensitive sectors of the stock market. But it's not just the Delta variants. It's also, the Fed's pivot toward a more hawkish posture is playing part of it. But we've also seen some muddiness in U.S. data, right, Brendan?
Both U.S. data and also especially international data, specifically Asia, which has really been slowing down because of COVID. But the U.S. data in the spring really very much disappointed expectations. They were very, very high expectations. We're getting vaccinated and it's going to be the roaring 20s. And while the data has been good, I don't think it was quite exactly up to the expectations when we were looking at it, say, in March timeframe.
And just to note, we have
especially the labor market that has been much slower than one would have thought.
Yeah, very idiosyncratic, and questions about, is the back to school that threshold moment where people finally say, okay, well, I'm done with my post-COVID summer. I've taken the family, or I've taken a little time off, and now it's time to get back to work, and now the kids are going back to school. And it certainly is it's a key moment for the U.S. recovery, no question about it. At a time when seasonal uplift in COVID cases might be playing an increasing role too. The other thing we'll talk a little bit about as we go forward is the possible loss of momentum in the infrastructure bill negotiations. When the steepening yield curve really kicked in after January, February timeframe, after the Democrats swept in Georgia and captured both houses of Congress, the idea was that the Biden administration would go big or go home. They would hit the market with like $6 trillion in fiscal stimulus. And now it's pretty clear that they're not going to get anything close to that necessarily right off the bat. And they're going to balance it with pay-fors, which wasn't necessarily as front and center in the thought process at the beginning of the year. So we'll talk a little bit about that. But questions about what's really going to make it through those narrow majorities in both the Senate, but underappreciated narrow majority in the House too. They can't lose votes anywhere. On the inflation story, as we mentioned, inflation has been one of those. Obviously, just as it got into the concept of the sort of mainstream media, the market was maybe moving on to the next thing. We've all seen 5 and 10 year tips break evens coming off their May highs. In pretty comfortable margins there. And a lot of the main signifiers of price pressures, lumber prices, rolling back over and retracing their highs.
We're back to almost normal on lumber prices.
Yeah. and industrial metals prices coming off. If you're, traditionalist in markets, you're looking at gold as an inflation tell, and that's down 5% for the year, and it's been choppy and not really going anywhere. And so, reading the tea leaves in the markets, it looks like investors have, on the margin, kind of moved on to a different story, and despite the upside in inflation risks, really internalized the Fed's transitory thesis. But Brendan can speak to some of the idiosyncrasies that are showing up in these numbers, which are genuinely crazy.
Yeah, as of now, I think the Fed has a strong case that these are transitory factors that have been driving the last, say, 4 months. Basically, when you look at the core CPI number the other day, only a third of the components were at a rate above 2%, which is the lowest it's been since 2019. So it has been very, very much concentrated in a few things, and specifically used cars, which I don't think Fed policy is going to have any effect one way or the other on used car prices. We bought a bunch of cars, and now we don't have any more cars, so we got to start making cars. And that is seeing. Actually, today, John, I know you used to cover Taiwan, but a big problem was the semiconductor problem. And on their earnings call today, Taiwan Semi said that we think we've got it fixed. The backlogs are done, and specifically talking to the car companies, that they expect to be able to fulfill their normal demand.
That's incredibly welcome news. The degree to which the chip shortage affected so many different industries, and that was among the key bottlenecks, and not the only bottleneck, but among the key bottlenecks in manufacturing, certainly. And so our base case for growth is that we do get through. Base case for growth and inflation is that certainly the U.S. economy clarifies to the upside over the fall, and that back to school is successful. On the issue of variance, I would like to invite anyone who's interested to contact us through our. We've got our contact information right here. We have a very close associate who is one of the leading virologists at George Washington University, who has some great perspective on this, and we can and has given us, I think, some real comfort and perspective on just how, just what kind of impact we can really expect from the kinds of variants that are out there now. And in the inflation, the medium term, we're still in the transitory camp along with Chair Powell, but over the longer term.
Exactly. That's a different question. So we're printing a lot of money, not just us, but the rest of the world. And we do think we're going to get a two big infrastructure bills, actually. So that's going to be another, probably $4 trillion in debt that we're going to have to issue on top of what we're already spending.
Yeah, and on the subject of one of the final topics we're going to talk about before we turn to Q&A is the U.S.-China friction. This is clearly globalization in reverse for a variety of different reasons. The disinflationary dynamics that accompanied the process of globalization are on the margin in going in the opposite direction, and that's associated with not just U.S. industrial policy, although that's part of it, but it's U.S. national security. And there was, nothing more starkly presented by the pandemic than the tenuous and unsecure nature of U.S. supply lines in very strategic industries, and that's something that the U.S. government is seeking to fix. That is not a disinflationary dynamic. It's quite the opposite, but it's an imperative that is a policy imperative that is understood on both sides of the aisle in the way that few issues are.
Very important. This is not a partisan issue. This is bipartisan. Trump administration did the Kodak thing, which was a little bit of a disaster in terms of implementation, but the idea was very solid, and the Biden administration is still running with that concept.
Yeah, and we just saw a bipartisan bill pass through the House that was essentially, it's the U.S. competitiveness bill, but it's essentially an industrial policy bill, putting money behind, high-tech manufacturing here in the U.S. We don't want to go too far down that road, but because the big bill coming through, or the big pair of bills coming through, or the twin kind of American Jobs Act infrastructure. We just saw some headlines come out today about Senator Schumer, Majority Leader Schumer, intent to take the bipartisan bill to a floor vote imminently. and within days, not weeks, to force a to force a decisive moment on this and see whether we can do this in a two-part fashion, as obviously the Biden administration would want, or if they have to go with a straightforward one bill solution that uses reconciliation. Our base case is that this is no easy process. There are going to be a lot of drama and horse trading along the way, but this is a gotta have for the Biden administration. And the Democrats are operating with a level of urgency that they may not have had in sort of previous, that we may not have seen in recent history. And they may not get it by Labor Day, but they're going to get a multi-trillion-dollar infrastructure bill, whether it's by reconciliation or whether it's the two-track bipartisan. And whether it falls on this side or that side of Labor Day, we think that they get it by early fall.
And that's important. You can get very pessimistic if you follow the day-to-day tweets and what's happening, but this is one where you need to look at the forest and not the trees. Back when Trump wanted to cut taxes, corporate taxes, most analysts were very negative on it, and I was actually I thought they were going to do it for the simple reason that they wanted to do it, and they did it. This is similar with the Democrats. They need to do this, or else they have no shot in the midterm election. So, but more importantly, the Republicans also need to pass that's what they're going to run on the bipartisan, smaller, paid for infrastructure bill, and the Democrats will run on the big reconciliation bill. Otherwise, you don't have anything to run on. So self-interest is as big of a reason why I think this passes as that actually, whether it's needed or not.
One of the things to note, and obviously everybody in Washington, D.C. is focused on the legislative process right now. Well, not everybody. There are some core bureaucrats that are looking at actually executing this thing. It's a very challenging part of, if perhaps more challenging than the legislative hurdles. Honestly, the U.S. has not had a federally led infrastructure campaign in generations, and the kind of institutional apparatus that would be needed at the federal level to run something this ambitious doesn't exist. It doesn't exist right now, anyway. When we think back to the Obama era, post-crisis, the Build America bonds, those were like pretty big numbers, but they were hardly transformative. And one of the reasons is because the federal government didn't have an infrastructure policy. The policy was fix what needs fixed. We give money to the states know what needs fixing, they go and fix it. Well, when you put money in the states, in a lot of states these days, federal money going into states is like water in the desert.
Yeah.
And, it doesn't necessarily have a really deep project pipeline to go right into make an economic difference. And that, I think, is a really key aspect and something that everybody should be aware of. This is now an infrastructure policy. They have top-down goals, the electrification, the upgrading and hardening of the U.S. Grid and other, water and key infrastructure, alongside equity, basically social equity goals. Those are not achievable by the Biden administration in a kind of traditional infrastructure format where the federal government just gives the money away. They're going to have to be directing that money. So in terms of executing, and the project pipeline is going to be something that they're going to struggle with, because right now, when talking with industry leaders in infrastructure, they note that the projects just aren't there to absorb that kind of capital, and a lot of groundwork has to be done. And so we want to flag that the institutional arrangements, whether it amounts to a national federal infrastructure bank, we don't know if they're able to go that far, although some of the legislation has actually put forward that idea. But a national, basically a federal infrastructure council, an Operation Warp Speed approach that centralizes the authority and the decision making in a big, like, muscular West Wing and federal government institution that they build up to be able to direct that money and make things happen, is going to, in our view, be a real difference maker as to whether this money just kind of goes out into the ether, or whether it actually, whether it actually gets traction in major infrastructure upgrades across
Right.
the country.
And we're not lobbyists at all, but we do have interactions with the West Wing. And one thing we're simply telling is don't pay for this. Let the private sector pay for it. We have pension funds and insurance companies that are dying for yield that would love to be able to do this. Just look how Australia does it. Look how Canada does it. And hopefully they do seem to be listening deeper and asking questions that you would hope that there's a possibility for that down the road.
There's clearly an appetite to try to do new things, try to do this a different way. Everybody knows that infrastructure, the old ways of doing it haven't worked. And it's not just, the institutional problems, it's the approvals and the EPA stuff and those regulations.
Yeah, exactly.
Very, very, very challenging problem. But they're certainly working to come to grips with it.
Right.
And just
the same way that we created a COVID expert task force, we should create an infrastructure expert task force and have it be sitting in the West Wing.
Yeah. If you have these disparate, if it's run by, the way that we always have done it, with the Department of Energy doing some of it and the Department of Transportation doing some of the rest of it, maybe like a couple of folks in the White House that are running it, it doesn't survive a presidential cycle. And it doesn't have that durability of institutional knowledge. When I was at the Treasury Department at the end of the Obama administration, like the 3 people that knew something about infrastructure were all Obama appointees. They all left. Yeah. There's just no muscle memory in the U.S. federal government about how to do a big federal top-down infrastructure campaign. And let alone where the files are and who knows what they're doing on this space. It's very fragmented among agencies that don't work well together. And the West Wing needs to fix that if they're going to make this really real. And lastly, one of the things that we've been talking about a lot with our clients, and we've been talking about it since the Trump administration, was the U.S.-China shift. We had flagged this as something that was, a bipartisan, one of the few bipartisan issues that would really enjoy a lot of continuity from the Trump administration into the Biden administration.
Right.
All through the Trump administration, the Democrats in Washington, D.C. were watching what he was doing on China and saying, we should have done that. Darn it. They were quibbling, obviously, with his methods. Obviously, they were quibbling with his methods and his prioritization and how he's doing it. But the Democrats were, to some extent, kind of kicking themselves and saying, that's our policy that he's taking. And so it's not a big surprise to us that the Biden administration is keeping on these tariffs. They don't gain anything politically by rolling them back. No. And the understanding across the aisle that China is not in a converging path with Western values and set to be, the richer they get, the more likely they're going to be, positive and constructive actors on the world stage. Boy, has that thesis not played out. And so that is animating a multi-front campaign to counter China's ambitions on the global stage. The Biden administration is changing the prioritization and the style from the Trump administration, but the broad direction is exactly the same with a more multilateral.
Yeah, I remember you were saying, like, when you started at Treasury, in terms of the career bureaucrats, that was the consensus view of China, and that it couldn't be more different now. That no one believes that anymore.
They lost the argument the day that it was announced that Xi Jinping would abolish his term limit in the second term. The convergenists, the convergence thesis within the Treasury Department and elsewhere in the U.S. government, they lost the argument decisively that day. And there's been no looking back. It's pretty clear the direction of travel. So we expect Chinese companies to be facing a much beefed up disclosure requirements that are going to be coming out of the SEC. We think that this is, they're just going to have to. And the Beijing is basically making the case for U.S. regulators better than they could make it themselves by battering Didi and some of the other and Ant and so forth. So Chinese companies and ADRs are caught in a vice with their own government pressing on one side and U.S. regulators and policymakers pressing on the other. It's a very challenging time, and we don't think the pressure is going to let up anytime soon. So we've gone,
maybe just a word on crypto, especially following on your China point.
Oh yeah, crypto is also taking it from both sides. U.S. regulators and Chinese. The Chinese have been even more aggressive than U.S. regulators in basically restricting and prohibiting in a lot of cases cryptocurrency activity. It's counter to what the Chinese want to do. Money walking out the door for them is not something that they are particularly thrilled about, and will want to keep clamping down on to the extent that they can. But in the U.S., the government has mandates that they cannot let slide when it comes to crypto, and those are terrorism financing, taxation, and investor protection. And that doesn't mean they're going to ban crypto, but it certainly means that they are going to draw some increasingly bright line rules when it comes to taxation, and when it comes to what is a security, which the idea that they're going to get a big free pass for a number of years to get through the early days of the the early parts of the Howey test to exempt them from being a security. We don't think that they're going to get that leeway, and that these are going to be swept into a securities regulatory regime in pretty broad brushstrokes. And
especially with Gary Gensler, who has an intimate understanding of the crypto world. So the previous administrations, it just wasn't big enough for them to tackle it. Now it's big enough that it has to be tackled.
It was kind of a running gag in the Trump administration, really. Like like the discussion of crypto was sort of a lark and not really considered particularly central. But that's changed a lot, and Treasury Secretary Yellen is clearly no fan. It seems, and our conversations with policymakers all fall along a pretty skeptical spectrum. So we'll pause there for Q&A, and thanks very much for taking the time to join us today.
Thanks, John and Brendan, for those great remarks. We do have some questions queued up for you, so we're going to get right into it. The first question I have for you gentlemen is, given how the Fed has changed its communications policy over the years, how could or would a taper tantrum 2.0 manifest in today's markets?
I think that we've seen part of the answer. It's going to be played out in miniature. I think is probably the answer. When Chair Bernanke started talking about it in his testimony in 2013. It was not long after the sort of QE infinity had started, and traders. I was in Indonesia at the time, and we had a very large position in rupiah, and I felt like he'd rolled out the red carpet for us to take a ton of levered carry in these EM currencies, and then yanked it out from underneath us. And the Fed looks back at that as it's pretty expressly understood as a policy mistake. And so the way that the Fed has come at the taper is, instead of not talking about it, they want to really gradually get into it. And so that reveal in the minutes from the April meeting that, oh my gosh, they talked about a taper. They talked about talking about a taper in the April minutes. It was that sort of broke the ice, and it's been a drip, drip, drip. And they've kind of attempted to boil the frog. That hasn't inoculated the markets against the impact of this discussion. Clearly, we've seen the hawkish tilt being expressed in the pop in the dollar, the flattening of the Treasury yield curve, futures markets pulling forward rate hikes and so forth, a less reflationary tone altogether in markets. But it has been, it's been played out, as I said, kind of in miniature as the doves and the hawks kind of have this debate in public, and with Chair Powell telling you the whole time that he is not going to surprise you, he is not going to shock you into a taper tantrum, and that gradualist approach, we think that they're really happy with the way that's gone so far, and we think that they continue this kind of extended dance remix of the taper.
Yeah, totally agree.
A second question here. I'm laughing. It's kind of funny. How much do you gentlemen trust Chinese state data?
Well, directionally, it's probably somewhat accurate, but that's about it.
Take it with more salt than you take in your margarita rim. I mean, it is. It's man-made. The Chinese. When I was at when I was at Discovery when Brendan and I were at the hedge fund, I covered China very closely. We took them as sort of directional indicators, not as actual, to the 0.1% kind of accuracy. They were indicative. We think that the Chinese aren't able to necessarily, completely misdirect trends and paper those over. If the economy is slowing, it will show up in the official data, but not perhaps in the kind of abrupt way that it may show up in places where the inputs aren't as stage managed. There's not a lot of, we don't think there's a lot of appetite in China right now for big, bold strokes in the economy. The PBOC has said that repeatedly, that they're looking for stability over stimulus. And that's, born of really hard experience. When you look back at some of the, the pops and drops in the Chinese economy over the post-crisis period, it's not been, it's not been optimal by any stretch of the imagination. And they've got some big debt worries that they're still grappling with, whether it's Huarong, whether it's the private sector with Evergrande. I mean, some of these are big debt bombs, and Beijing's trying to figure out like just how much of a bailout should we really apply to some of these cases. And so they've got when we look at, it's really hard to, the normal things that we would look at would be like CRB raw industrials. You'd be looking at copper prices and trying to build the mosaic from a variety of different market signals as to what's really going on in China. And some of the stuff that's less toyed with, like rail car loads and electricity usage, and some of the stuff on the ground in China that's a little cleaner that you can hang your hat on. But, with all the distortions from the pandemic these days, it's hard to get a picture. So right now, we're taking them at face value that they're steadying to slowing, but the actual numbers themselves, we usually disagree.
Right. I mean, they just cut the loan prime rate. They did that for a reason. Things aren't going well over there. And COVID is resurging, and they have a pretty crappy vaccine.
Our friends in Thailand said that. Everyone was, the Chinese are like, here, have more. And Southeast Asia's like, we're good.
And I have one last question, and this is regarding a remark that you made during the presentation about the United States and other countries throwing a lot of money into the economy to keep them going, prop them up. The question is, how do you get people eventually used to not so much free spending and free money out there? You take away the infrastructure package, you take away the free checks we all got earlier this year. How do you get Americans back on budget?
We're actually getting more free checks. It's kind of an under the radar stimulus, but 40 million Americans are getting, $300 per kid in child tax credit. So the stimulus is not over. It's still coming.
I think from the political perspective, I don't want to veer too much into the political arena because everybody, everybody speaks in exclamation points on that in Washington, D.C. here. But I can certainly tell you that the Democrats feel as though they are in a very high urgency situation, and their approach has been, damn the torpedoes. We've got to win in 2022. We've got to keep and expand the majorities in 2022, and everybody's looking out at 2024, and the political imperatives. We're not in an emerging market, but anybody that like Brendan and myself, anybody who's ever traded and worked in emerging markets, watching politics in cases where it's win or the stakes are higher than just a defeat at the ballot box, and I think that there are a lot of Democrats in Washington D.C. that think that there's more at stake, and that how to shore up their base really comes from that expenditure model where you're getting money into people's pockets, and you can hear it when the Senate Democrats start quoting, Senator McConnell when he's saying, we voted against all this stuff that's going to be putting money in the pockets of people in Kentucky, and the Democrats are making hay with that because that's a big part of their program, and it's considered and it certainly appears to be a political winner at this point, which is one of the reasons why we're getting the potential for a bipartisan infrastructure bill, and less. It's hard to push back on some of these things in Washington, D.C. So the policy direction, this is coming at a time when deficit spending, the Obama administration.
This is an important point. Yeah.
Yeah,
very
part of it
important.
was forced on them. When I was in the Treasury Department, when I joined the Treasury Department in 2014, it was basically consensus that the fiscal rectitude that followed, aside from the very early post-crisis period in the early Obama administration, was a mistake, and that they weren't fiscally bold enough. They weren't bold enough with their programs, with their social programs, or really anything. And that went for the Fed as well. There was kind of a consensus among the Obama crowd that in the later years, that the Fed was a little too quick on the trigger when it came to rate hikes, and it bequeathed this low rate forever kind of equilibrium, which Fed Chair Powell, as we all remember, was unable to escape from in 2018 when he raised interest rates to the eye-wateringly high level of 2.5%, which was so tight that it nearly derailed the financial markets. That's considered very worrisome by the Fed. It's something that the Democrats think about a lot, and the Democrats have said basically like, hey, every time we get our guy in the White House, we have to follow this like fiscal straitjacket. And every time the Republicans have their guy in the White House, they spend like drunken sailors. So we're sick of being the chumps at the table. The constituency for debt rectitude and fiscal conservatism is so depleted now. Even the Tea Party couldn't find their Tea Party costumes in the back of their closet. They're hitting the Biden administration on inflation, not on deficits in the same way they did in the past, because their credibility's shot. Joe Manchin, Senator Manchin is like, and the moderate Democrats are the few that are still talking about like deficits as a real kind of scare story, and the Washington consensus has really moved on from that, rightly or wrongly, but it has.
Right, I agree.
That's great, gentlemen. Thank you so much. And for our viewers, this concludes the monthly Capus Research Call. We'd like to again thank John and Brendan of Market Policy Partners for participating and sharing their insights. Our next research call will be on August 16th, so please, everyone, stay tuned. On behalf of the Capus family and Market Policy Partners, thank you for watching, and have a great trading day.